Okay everyone, in this video we're going to get into the second part of feasibility studies. In stage 3 we looked at market feasibility assessment, and at this point I should just mention the distinction between market and marketing. Okay, marketing is something we get into later on. Market is, do you have a market? What does the market look like? Who are your customers and that sort of thing. Later on we'll get into marketing, and it's in how you reach those people. All right, so that was stage 3. Now we're into stage 4, which is the cost and profitability assessment. This is going to be a particularly difficult task for any of you who have not had BFIN 161 or some sort of accounting, because there are 4 documents that you really have to have in your business plan in order to satisfy investors or banks, or even to give you some idea of whether or not you're going to be successful. And that's a balance sheet, a pro forma balance sheet, and pro forma income statement, and a cash flow analysis, followed by a break-even analysis. Okay, and right off the bat, I'm going to apologize for my lack of expertise in this area. I teach Management 101, I teach business law, advanced business law, and international trade law. So my strength is in the legal considerations, which is 2 stages farther on from this. Other instructors, accounting instructors, generally don't teach this course. So the hope is that you either have that sort of background, as I mentioned in the introductory lecture, or that you have teamed up with someone who does. When you actually do your business plan, right now I'm going to tell you that I'm going to concentrate on your cash flow statement, all right, because that I have a good handle on. Setting up your pro forma balance sheet and pro forma income statements, they're important. You should do them. I'm not going to take as close a look at them because this is a learning exercise for you. So, for example, this chapter is a do chapter more than a lecture chapter. When I get into legal considerations, there is just so many legal considerations that it will be a lecture chapter. I'll be telling you the different forms of business organization, how to protect your idea, that sort of thing. This chapter, you're going to have to sit down with the textbook, you're going to have to sit down with your material, and you're going to have to work through it yourself. This textbook is really good for that. Okay, it really tells you how to go about doing these things. Okay, now let's see. We start off on screen 61 of my lecture guide, and screen 62, which, there we go, sets out what's contained in the chapter. Okay, so the first thing you do is you determine your startup financial requirements. This is incredibly important when you get to your cash flow. And we'll get into that a little bit more in the next slide. But then you have to develop your short-term financial projections. And a lot of people look at this as, okay, I have to have a project for this class that shows I'm going to make a fortune. I'm going to be able to get my financing. That's not the point of the exercise. The point of the exercise is to have a realistic projection. So your short-term financial projections have to be realistic. Then you do your pro forma income statement. This is your expected revenues minus your expected expenses, which gives you your profit, okay, before taxes. Then you get into your cash flow, and we'll talk about this more later on, but it's figure 4.4 on pages 116 and 117, all right? And there is, you can, through the, what do they call it? The Connect. For this textbook, you can download a blank Proforma income statement, and you just go through and you fill in the blanks, all right? It's a little more complicated than that, and we'll get into it. And then you have a pro forma balance sheet, which you have to do. Once you've done all that, then you can determine your break-even point. And quite frankly, even in the MBA program, I struggled with calculating the break-even point. So again, you're going to have some difficulty there, but hopefully you'll struggle through. And then once you've done that, you will complete your comprehensive business feasibility study, because you've got the market feasibility assessment and you've got the cost and profitability assessment. The next slide, we get into the meat of it. Determining your startup requirements, financial requirements, you're looking at one-time expenditures. If you started off in a business, for example, let's say the gotta have a Java coffee shop. You look around and you go, hey, wait, you know what? First Cup and Starbucks have missed this particular shop. Hey, there's no Tim Hortons here. This gives me a chance to go and be the firstest with the no, not the first, to hit them where they ain't, okay, which is Drucker's suggested marketing plan, where you go where the competition isn't and get a foothold in the market. So you find this place, and so the first thing you have to do is lease premises. We'll get into some of the legal pitfalls with that, but when you lease premises, the coffee shop isn't set up for you. And if it is, then it's a business that was there that failed, and you better take another hard look at the location. But anyway, there'll be this place, and it's relatively simple to set up a very comfortable looking coffee shop. And let's say you have some sort of service or environment that is better than Starbucks, and you know that Tim Hortons, pretty rudimentary shops, just booths and chairs and things like that. So maybe you have lounges where people can come in and they can read the paper and converse with other people and work on their computers while they drink coffee. Some niche thing that makes it important for you. So then you say, okay, I need the leasehold improvements. I need to paint the place. I need to put in different lighting, and there's going to be a cost associated with that. And then you just estimate that. You could do something really remarkable, like you could actually talk to the owner of one of those shops and find out, say you're doing this exercise for Capilano University, and roughly how much did your leasehold improvements cost? And then fixtures. What's fixtures? Well, that would be the coffee equipment. It would be the chairs, the tables. Leasehold improvements are attached to the premises. Fixtures are things like equipment and machinery that you need. Then you look at licenses and permits. Well, go to the municipal hall. I mean, you should go to the municipal hall. If you put in, let's put in $300, I'm going to say, where did this come from? Okay, like $300. So you just contact the business or the municipal hall and you say, I'm thinking of opening up a coffee shop, and I need to find out how much I need in the way of licenses and permits, and they will give you an estimate of the cost. You might even be able to get it online, but you'd better back up your sources for me. Okay, so those are the one-time expenditures, and then there's the operating expenditures. Like what? Well, like you have to buy coffee, okay, and you want to have pastries or something like that, so you have to have these expenditures filled into it. This is covered in pages 103 and 104 in more detail. Then the next step is to determine your short-term financial projections. Okay, this is your pro forma income statement. So you figure out what your revenues are going to be over a year, okay, and you subtract the expenses from your operation, and that equals your net profit bracket loss. And I am seriously going to challenge you if you say, in my first month I'm going to make $28,000. People don't even know you exist yet, and you think you're going to make that much money? So there should be a gradual increase in the net profit, but we get into that in cash flow. Right now it's just the yearly figure, okay? And this is before taxes. All right, next slide. Cash flow statements. What is cash flow? On slide 64, I defined it. Cash flows are the net amount of cash or cash equivalents being transferred into or out of the business. Cash received are inflows and money spent are outflows. cash equivalents. What the heck is that? You have already some things like tables and chairs and things like that. Okay, and so cash is investments, that money cash that comes in. Cash equivalents are tables and chairs and pictures for the wall and things like that. Okay. At the bottom of the screen, there's a bullet that says cash is king, bracket, or queen. There's a term that's quite often used in business, cash is king, because a business lives or dies by the cash that comes in, which should be sufficient to and in excess of the cash that goes out. So cash is king. And if you can do anything to generate cash revenues quicker, then you'll be better off. Okay, I put word queen because that's, in this politically correct environment, I think you should say cash is king / queen. Okay. Now the cash flow statement, and this is the one that I'm going to look at really, really closely. It's the estimate of your revenues. You determine your expenditures, and you reconcile the cash revenues. Okay. Now, let's see if it's on the next slide. If you go to page 116 of the textbook, it shows you a cash flow, and like I said, you can go on to Connect and you can download one, and there'll be lots of these things that you don't fill in, okay? And so this is for Tough Guys Sporting Goods, and I can't tell from this whether or not it is a startup or whether this would be like this. Oh no, well, it says year one. Okay, and so I would find this somewhat suspicious that you open up a Tough Guy Sporting Goods store and suddenly in the first month you make $17,000. You open the doors, people don't know you're there, you're marketing locally. I think your revenue would be a lot smaller than that. The only realistic thing about this is that in its first year, it didn't show a profit. Okay, so the revenues increase: 17,000 in January, 25,000 in February, 33, 43, 48, 55. Wow, you're doing good. 68. Ooh, wait a minute. August it dropped off a bit. September it dropped off a bit. October it's down, and in November it's only 36,000, and then there's a bump in December. This is realistic in the sense that there are more sporting goods materials sold in the spring and summer months, and then it drops off in the fall as the weather turns bad and people go back to school and don't have enough time for sports. And then there's a bump because Christmas. Hey, you're not only buying sporting goods materials for yourself, but you might be buying them as presents for others. So I like that. Payments for cash sales. Well, I'm just looking at them, and again, it sort of follows along. Payments for cash sales. Yeah, that's not bad. It's realistic. I find that the total payments for cash sales. This is one's cash. Okay, that's here's $20, and the other is charge cards. Income investment. Well, the business doesn't have any, and that's quite realistic, and yours will probably be that too. If you were making a huge amount of money and every year you had this cash surplus at the end of the year, and you took that and said, okay, we can either put it in our pockets or we can invest it in the business as a contingency fund or something like that. So we invested in GICs that are owned by the business. Then you would have investment income coming from that, and other cash income. I have no suggestions there. I would suspect that in yours, unless you have some other income coming into the business, well, let's put it this way. Let's say this has been operating for a number of years, and in April you franchise another store, and there would be a franchise fee up front that they would pay to you. So there might be a $25,000 other cash income there, and then subsequently there would be royalty fees for that. So let's say the royalty fee is 10% of their earnings per month. Well, they make $17,000 in their first month. 10% of that would be $1,713. Okay, or it might be a set royalty fee, $1,000 a month. Okay, then you get into your expenditures, and inventory or new materials. Obviously, they have to buy inventory and bring it in. I would have thought that the inventory to fill the store would have been a big whack up front. Okay, so it says year one. So what have you got? You've only got $31,000 of inventory on the shelves, but by June you've got $62,000. I would suspect that there would actually be a substantial amount more than that. Then owner's salary is how much you're going to pay yourself. So you've done this personal financials statement, no budget, okay? And so you realize, well, I need about $3,000 a month from my work or from my business to survive. That would be what goes in there. Employees' wages and salaries. Why do they go up and then down? I guess what they're doing is they're hiring only a few people initially because they're not going to be that busy, and then as they get busier they hire more people, and then as they hit into their low months, they start letting people go on a part-time basis. Supplies and postage, zero. Okay, they don't have that. This is things that you're buying to run your business. Advertising and promotion. You would think that the advertising and promotion just before Christmas would be bigger. Okay, so they show it increasing over the summer months when they're really busy. But if you're a sporting goods store, you want to have a lot of sales and advertising just before Christmas. Delivery expenses, travel, none. Legal and accounting. This one I've got a challenge. I can't imagine that the store would need 2 hours of legal advice every month. All right, and I think their legal and accounting fees at startup is really low. Now this is presupposing, and what this author does is say, okay, you're going to incorporate your company yourself. Like how hard's that? We'll talk about that when we get into legal considerations. But your legal incorporation would be about $1,500, and then you've got more than one person involved in your business. You're going to have a shareholders agreement. Doesn't say whether this company is a sole proprietorship, partnership, or corporation. That will change. That figure will change depending upon your setup. As a sole proprietor, you have very low legal fees at the beginning, but you better get some advice from a lawyer as far as risk management. What insurance do you need? As a sole proprietor, should you have transferred your assets to your spouse or significant other? Things like that. But if you're a partnership, you're going to have a partnership agreement. A partnership agreement starts at $1,500 and goes up from there. So right off the bat, if you incorporate your company, you'd be looking at about $1,500 in legal fees. And I may be out of touch. I mean, I had very low overhead, so I could incorporate some pretty extensive corporate share structures, for somewhere around $1,200. But I doubt you could go to a downtown law firm and get that. So let's say $1,500 for incorporation, and then you've got $2,000 for a shareholders agreement. Who needs one of those? We'll talk about that later. You better have one. Okay, and then you're leasing premises, obviously, because I think there's rental payments here. Yeah, rent. The leasing payments. You better get some legal advice on the offer to lease that you have with the landlord, and you'd better have a lawyer review the lease. I review a lease for $350, so let's say $500. Okay, so suddenly you're looking at legal fees way too low at the beginning, and then you start operating. I can't think of, hey, lawyer, hello, I need some advice. Anyway, vehicle expense, none. Maintenance expense, yeah, they estimate that things like, somebody breaks something and you get insurance, but you have to, get somebody in to fix it and stuff like that. Then your rental payment. You could, if you're doing this as a project, you had better contact a rental agent and say, okay, look, I'm doing this project for Capilano University and the School of Business. I was thinking of renting a 1,000 square foot shop on Lonsdale, or in Lower Lonsdale, or somewhere like that. And what's the approximate square footage cost? Okay, and then you footnote that, and you let me know that you've looked at it. I mean, if you do the work and then you don't cite it, I go, hey, where did that come from? Okay, so you'd say rent, and you'd have a number there, and then there'd be a footnote down to the bottom of your cash flow, and it would say estimated in conversation with so and so, such and such. Okay, what else? Utilities, you can find that out. Telephone expenses, you can find out. Taxes and licenses, none. Interest payments. Now they've got financing, so they get a loan, probably an operating line of loan in January, but they don't pay any interest in January. Interest accrues. So the first interest payment would be in February, and you can calculate that, okay? I'll contact a bank and you say, if I get an operating line of credit for $50,000 and I have $20,000 outstanding, what's my interest rate? Insurance, I don't understand why there's a $1,000 payment in January, a $1,000 payment in March, then May, because it seems to me that your premium is generally paid once a month. I mean, once a year. You may say, okay, it's very expensive, so you arrange with the insurance agent to have periodic payments. Again, back that up. Other cash expenses, wow, quite large. I don't know what those would be. Okay, so those are your total cash flow on hand at the beginning, and you've got your total expenditures, and then you just subtract one from the other to get your change in cash flow from purchase or sale of assets. Probably none. And the other thing about this business is it's obviously minimum cash balance required, $5,000. It's obviously, well, it seems like it's a startup, but the one thing your cash flow is supposed to say is, this is how much cash I need, and this is how much I'm going to get from sale of my coffee, and then you say, well, wait a minute, I'm going to have gradual growing sales, but all these expenses are really large. I'm going to lose money. Well, you have to have your investment money up front. So you would indicate the cash that's coming into the business. Okay, so you would say, I've got $28,000 that I'm putting in. That would be in January. Okay, and I've got $40,000 from the bank as a fixed loan. That goes in, and then when you get down to the bottom, you would say okay, I'm really good in January, okay, but then I have all these other costs coming out of it, And okay, my financing means I'm going to make it through the first year and still have some reserve, or by December I'm going to be out of cash. I need more investment income. Okay, so that's the kind of thing you do with your cash flow statement. So cash flow, estimate of revenues, determine your expenditures, and reconcile your cash flow. You can simplify it substantially, okay? Because what I want to know is that you've got your investment income and your financing from investors up front, and then these cash revenues coming in, okay? And then I've got all these expenditures going out, and the line I want to see at the bottom is, do you have enough cash in investments to survive? Okay, done that. Proforma balance sheet. All right, we're going to get into that in a minute. We are on slide 67, and we're talking about the Proforma balance sheet. Again, these are one of the documents that I'll probably give you a little bit of leeway on. Banks really like them because it gives a snapshot of your business's health at a certain point in time. When you start off and you do a pro forma balance sheet, the idea is, okay, at the end of year one, what are you going to look like? Okay, and it tells you the value of your business at any point. Generally, you do it for the end of the year, but you can do them periodically if you want. At any point, by forecasting what your business will what your business will own in the way of assets, and what it will owe in the way of monies payable to people, investors, and other financial institutions. This allows you to determine what your net worth is. We have talked about your personal net worth statement. When you take all your personal assets, you minus the liabilities, and it equals your net worth. So the idea is that you take your in the pro forma balance sheet for your business, it's a little more extensive because you take your current assets, which is the estimate of your expected average accounts receivable. Okay, now this business, interestingly enough, did not have accounts receivable. I'm pointing at the floor because that's where I put the textbook. The sporting goods business will have accounts receivable because they will perhaps make some sales, larger sales on credit 30, 60, 90 days. So those are assets. And then you have startup inventory requirements, and then that business, the startup inventory was really, you want people to come in and go, wow, look at all this stuff. You don't want them to come in and say, oh, they're a startup, so they only have a few things in the shelf. So the startup inventory would be substantially more than what was in that particular example, I would think. Okay, so that's your accounts receivable, your startup inventory, available cash is your current assets. Okay. And then your fixed assets are your building, furniture, fixtures, machinery, equipment, and automobiles, if any, and other capital items. Other capital items are things that you have to buy for your business. Personal property, tangible. Okay. Okay, and now that I think of it, I'm going to back up for 1 second. In your cash flow, if you have a business like Gotta Have a Java, you'd better trademark that name, and because your business is going to become synonymous with that. Oh, let's go to Gotta Have a Java. They don't go say, okay, let's go and find a coffee shop. No, you say, let's go to Starbucks or let's go to Tim Hortons. And so you want to trademark that, and the book suggests that you can do it yourself. I'll talk about that later. But there's a cost to it. There's upfront payments to the government. if you do it yourself, okay, and then you've got to put those in your cash flow statement. All right, so let's see. We got the current assets and the fixed assets, and there's an item on your balance sheet called depreciation, and if you have a building, it's depreciated at a certain rate. If you have equipment, it's depreciated at a certain rate. And you have to do some investigation and find out which is the most appropriate. Land does not appreciate unless there's a flood and it gets wiped out. So if you own a building and land, then you have to determine how much the building is worth, and you depreciate a building over a long period of time. And then you depreciate your fixed assets over something like a 5-year period. So you have your fixed assets less depreciation. Then the next thing to do is look at your liabilities. On screen 68, it talks about current liabilities. There's the debts expected to fall due over the 12-month period, okay, of your balance sheet. And so the textbook explains that figure. Then long-term liabilities are outstanding long-term debts, such as mortgage, PPSA, on machinery and equipment. Now, I think the book talks about charges on machinery and equipment. In some provinces, that will be called a collateral mortgage. In the province of British Columbia, it's called a personal property security agreement, which means that you got equipment which is reflected as the value of an asset, but on that equipment, you got a loan from the bank, and they file a PPSA agreement with the registry in Victoria, and you owe money on that. So that would go on the liability side of your balance sheet. Okay, once you've got your assets, and there's a number at the bottom, and you've got your liabilities, and there's a number there, you go, wait a minute, the balance sheet has to balance. So my assets are $40,000, my liabilities are $30,000, my net worth must be $10,000. Okay, so that's the idea. And once you've got your estimated profit and loss statement, your cash flow, and your pro forma balance sheet, you can actually do some analyzing of those balance sheets. And the textbook on page 120 talks about liquidity ratios, profitability ratios, leverage ratios. Those are good to do in two respects. Number one is the leverage ratio, for example, which you'll talk about, is how much debt I have to equity. That's important to look at, because if your debt to equity is outrageously high, then what you're over leveraged, and the bank will take one look at that and say, we're not touching this business with a 10-foot pole, because the risk is too great. We're not going to be part of that debt when they have very little invested. The other ratios are important for analyzing your business more on an ongoing basis, because if you're in an industry that is well established, there will be ratios available that you can then look at your ratio, your liquidity ratio, and go, whoa, I'm in trouble with respect to the industry average. I'm out of whack here. And things like that. When you're a startup, it's an estimate of where you're going to be at the end of the first year, but you have to take into consideration that you're very seldom, if ever, going to make a profit in your first year. By the end of your second year, you're making a little bit of a profit. By the end of the third year, you're okay. And so that those ratios sometimes are not really indicative of your true position. The break-even point you're just going to have to struggle with. It's pages 121 to 125 tell you, okay, once you've got your pro forma financial statements, pro forma meaning it hasn't happened yet, this is my estimate of the future, then you're going to be able to do your break-even analysis. And the break-even analysis is really important because if that indicates that you're not going to break even until your 7th year, you're going to be out of business. You will not have enough money unless you keep putting money into the business until you get to the point where you actually start making a profit. Okay, so one of the key documents which allows you to monitor your progress and is one that you don't have to go to your accountant to get calculated if you're incapable of doing it yourself, is your bank statement. Okay, the bank statement shows the money that's coming in and the money that's going out, and it's sort of one of those simplest guides you can use to determine how your business is performing, and that is stage 4. Your cost and profitability analysis. I think at the end of stage 3 I said, so that's stage 4, but that was just a slip. This is the end of stage 4, and as I mentioned, this is a do it chapter. You're just going to have to sit down and do it, and you better sit down and do it fast because this term is just going to fly by. Okay, so that is stage 4 done.